Financial markets are weird at the moment. Cryptocurrency prices are through the roof. There seems to be a bit of a bubble in electric vehicle companies. And more broadly, there just seems to be some weird investor behaviour going on, especially in niche stocks like GameStop, where they're getting bid up mainly just because of memes and are completely detached from fundamental value. For the first time the other day, I saw the phrase diamond hands on Bloomberg TV. So things seem to be changing and there's some weird stuff going on. And it seems to be a bit of an indicator of a bubble in my mind. I think a lot of what's driving this is a combination of heavy Fed liquidity, which is pumping up asset prices, which is flowing through into, more niche assets like crypto. And at the same time, savings on average have gone up because in the US, people are getting stimulus checks. And in the UK, we're just locked down, so we can't spend our money. And if you combine that with the fact that, people aren't leaving their houses as much, people are bored, people are trading, people are posting memes, so people are doing some strange things. So since we're seeing a lot of investments, and I use that phrase very loosely, going viral and a lot of bubble indicators, in a few videos I just wanted to explain some of the things I'm seeing and pick them apart. So I think it's very important to appreciate that investments going viral isn't a new thing. It's been happening for hundreds of years. If you look back into the 17th century with the tulip bulb in the Netherlands, people were literally selling their houses for one tulip bulb because everyone thought they were going to keep going up in price. Similar things happened in 1928 before the Great Depression, where people were speculating on assets and using a lot of leverage. The same thing happened in the dot-com bubble, where anything related to tech was being bought up. And the same thing happened to house prices in 2007, 2008, before the global financial crisis, when people would have 5 or 6 homes because it was so easy to get the mortgage, because everyone assumed they would just keep going up in price. And there are some common things you see in all of these bubbles. For one, investors' perception of risk changes, and they fail to appreciate a lot of the risks they're taking. A lot of people will look at these investments just as get-rich-quick schemes. Then you start to see inexperienced investors piling into them because they have no idea what's going on, but they see other people making money and they have a fear of missing out. Additionally, random celebrities will start getting involved and they'll start telling people to buy in. And finally, prices will get completely detached from fundamental value. And then people start to argue that looking at fundamental value of an investment is old school and closed-minded and is no longer the way we should be doing it. If that all sounds familiar, it should, and in my view, these things seem to be happening now. And looking at things now, it seems like, every random celebrity's jumping in on some kind of investment. I mean, Mia Khalifa tweeted that she was buying Dogecoin. I bet she doesn't even know what it is. At the same time, every time Elon Musk tweets, he sends some asset soaring in price or falling in price. Just look at every time he tweets about Dogecoin and see what happens to the price. Similarly, there's been lots of pump and dump schemes going on, like the one that happened in Ripple, where a bunch of people went on different social media apps and told people to buy Ripple at a specific time, and then they'd all sell it at the same time. Obviously, it didn't work out like that, and the price moved up before that, but it was a complete pump and dump. Similarly, the GameStop saga happened and is still ongoing, and I'm going to detail that in a future video. And if you go onto TikTok, there's loads of, random videos where people are talking about the weekly tickers, random tickers they've definitely never heard of, don't know what they do, but they're telling people to buy them. There's even a website now which predicts Bitcoin's price based on astrology. Yeah, I don't think much more needs to be said about that one. I'm sure that to some people this seems like a rant from someone who, has studied conventional investment theory for years and works in financial services and only thinks one way. And I understand that. But in my view, there's a lot of investor behaviour that seems unsustainable, and I'm seeing a lot of patterns that have happened in previous crises repeating themselves. Now, that's not to say that this is a bubble that's going to pop. I don't know how this would end. It's very possible that as inflation concerns come back and economies start to reopen, stock markets decline a bit and retail investors slow down and realise that there is some risk, and things don't crash as such, rather they just correct. But if you look at the dot-com bubble, the investor behaviour went on for a couple of years before things really crashed. Even though inflation's probably going to pick up, it's likely that interest rates are going to stay really low because governments have so much debt at the moment and they don't want to raise rates because then they're going to have to pay more back. At the same time, it's going to take a while for them to unwind stimulus, because if they unwind it too fast and the economy hasn't fully recovered from coronavirus, they're going to cause a lot of damage. The same is the case for tax revenue as well. It's going to take a while for them to bring up tax revenue to start to pay down this huge debt that they've been building up. So, in summary, in my view, things are vulnerable, but they're not necessarily going to crash. My advice is just be careful, just watch things. If you want to make a YOLO bet on Dogecoin, go for it, that's fair enough, but just realise the risks that you're taking and the market environment that you're in, and realise that it's not going to be like this forever.